Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back. In part 2 of our palm oil series, we'll dive into practical investment plans, minimum viable packages, and key actions that mid-size companies can take to reduce risk and strengthen supply. Let's jump in. NDPE claims are broad, with no dates, scope, or supplier requirements. There's no public map or list of supplier mills. The company can't provide FFB origin data, even at a high level. No grievance log exists, or it's empty while risks are known. Audits stop at the refinery, with no mill or farm checks. Mass balance is used as a default, with no step-up plan. Public deadlines slip quietly, then disappear from reports. There's no budget line for traceability or smallholder programs. The real reasons companies stay on the sidelines, and what it costs them later. Tight margins push firms to avoid new spending. The later cost can be lost contracts when a buyer requires proof, not promises. Fear of losing suppliers keeps standards weak. The later cost is being forced into lower-paying channels when compliant buyers cut off supply. Weak data systems make traceability slow. The later cost is shipment delays when documents, geolocation, or mill lists are requested fast. Complex smallholder networks feel too hard to fix. The later cost is higher risk flags when unknown origins trigger buyer reviews. Short-term leadership incentives favor volume over verification. The later cost can be higher financing costs when lenders price in risk. The 2026 pressure points, where risk shows up first for palm oil companies. In 2026, risk usually appears in 3 places first: sales, financing, and operational disruption. It's rarely abstract. It's a buyer email that asks for mill coordinates within 2 weeks. It's a lender that wants quarterly KPIs tied to pricing. It's an insurer asking what you're doing about fire and legal exposure. For palm oil businesses not invested in 2026, the problem isn't that expectations are higher. The problem is that decision cycles are faster. Procurement teams don't want long stories. Credit teams don't want vague roadmaps. Compliance teams want evidence that stands up to review. A common pattern looks like this. A company has partial certification coverage and a policy, but can't show traceability beyond a portion of volumes. When a customer updates its sourcing rules, the company scrambles to collect data from third parties who aren't ready. That scramble costs time, and time costs margin. Market access risk, stricter buyer rules, more proof, and faster cutoffs. Large FMCG brands, retailers, and major traders are asking for stronger proof than, "We have an NDPE policy." Many now expect traceability to mill as a floor, with movement toward traceability to plantation for higher risk supply. They also ask for geolocation, evidence of supplier engagement, and a working grievance process. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.